Joining us now, Vital Knowledge founder Adam Crisafulli and Pictet Asset Management chief strategist Luca Paolini. Luca, you're here on set with us. I'm going to kick this off with you. Welcome.
Oh, nice to be here.
I mean, it's like April was a distant memory. We've got a record high in the NASDAQ. We've got the S&P closing in on its own record high, even as we had this hotter than expected PPI number. Yes, I know we've had revisions to some of the previous months, but what do you think of stocks here at these levels?
Well, let me say that there are very simple facts here. Corporate profits are very strong. The economy is strong. Inflation, yeah, is sticky, but I think the trend is down. And the Fed is probably going to cut rates. And add to this that Europe is probably picking up, China as well. That looks like a pretty kind of solid background for equities for the next few months, I would say.
Okay. Adam, how do you see this market? And I ask that knowing that has seemed like the market's path has been more easily higher than lower. And every time we have gotten some data that maybe could throw a wrench into the momentum, investors have shrugged it off, at least for now.
Yeah, I think the key with the PPI today, like you said, there was a big revision lower for March, but even the April number, which came in a bit hotter, it's not so much you're seeing a resurgence of inflation. We've had a stalling of the disinflationary process year to date. Markets can cope with that pretty well. In addition to that, you had the Powell remarks today, which I thought were more dovish than they were hawkish. You know, the bar for an incremental rate hike is very, very high, read between the lines. He does not sound all that concerned at all about the year-to-date trend of inflation. He sounds quite confident that you're going to see the rent component of the PCE and the CPI reset lower in the coming months. And he does seem more concerned about labor market conditions than perhaps the narrative is overall. So his comments were dovish. And then we have this steady stream of really important positive AI announcements, whether it was OpenAI yesterday, you have Google today launching a slew of new products and upgrades. You have the XAI Oracle news. You have a big Microsoft event next week for AI. You have NVIDIA earnings next week. So those three components, I think, were really just, help to power markets higher today.
All right. So, Luca, let's get beneath the surface a little bit more on strategy here. Despite expecting rate cuts and talking about how healthy growth has been, you're neutral U.S. stocks and looking more globally and into Europe. Now, the U.S. has outperformed so much, people might have forgotten how to move into it. So how would you do it if you have a portfolio that isn't as exposed to global stocks as historically gets recommended?
Well, look, the U.S. equity markets have done exceptionally well. But if you look at the last few months, you start to see Europe doing well, even China, Japan. So it's from one side, there's an element of diversification, especially if you're not based in the U.S. Basically, U.S. is an expensive market in an expensive currency. Now, momentum is strong. Corporate earnings are booming. But when you look at valuation, we look also at economic momentum, by the way. Economic momentum is picking up in Europe from an incredibly low level. But that's what matters for market, is the direction, not the level. So we see a positive outlook for Europe. Cheap market, good momentum. Probably ECB is going to cut in June. That doesn't change the fact that over the long term, the place to be is always going to be the U.S. But I think for the next 3 to 6 months, I think Europe, Japan can do very well.
Okay. It's worth thinking about. Now, Adam, looking forward to tomorrow and CPI, how relatively important is this print, given all of the maybe it means this, maybe it means that we've had to do over PPI today?
I think it's important. Obviously, the market is very focused on inflation developments. Based on the consensus forecast, this should mark the resumption of the disinflationary process. So on a core basis, you're going to see the largest deceleration on a year-on-year basis in several months, which kind of put us back on track to where we were late last year. We had this steady drift lower of inflation. It's definitely not a make or break number. And I think, if anything, an in-line to cooler figure is going to help stocks a lot more than a hot number will hurt them. But it's obviously going to be, very important, not just for markets. The Fed will be watching it closely as also. And then labor markets, like I said, I think the labor markets might be where we're seeing the larger inflection point. And we'll get the weekly jobless claims on Thursday. We'll see if that confirms what happened last Thursday. But that, I think, is where you're really seeing a potential shift, more so than on the inflation front, where, we've stalled for a few months, but I think you're going to see a steady the resumption of that disinflationary process in the coming months.
Given the fact that it has been a more risk-on sentiment across the markets right now, is there a place for bonds and fixed income in the portfolio, near-term, long-term?
I think so. I think when you look at the interest rate, but also look at bond yields in the U.S. and you compare with trend GDP growth, I think the level is pretty fine. There is a risk of excess supply, but we start to see private investors buying, also foreign buying investors. So I do believe that there is value in the bond market. In the short term, it's probably a little bit risky, but I do believe that for long-term investors, especially in the U.S., especially in credit, I would say more than government bond, there is good value right now.